and welcome everyone to the Closingbell Show, where you can invest with the best. This is the home for busy people to learn with other successful investors, navigate the macroeconomic climate with confidence, and receive undervalued stock opportunities without having to spend hours researching. Today, we spoke to Alex Morris from The Science of Hitting. Alex is a former buy-side equities analyst who has spent 10 years in the finance industry, managing $1.2 billion in client assets. He now writes the very popular The Science of Hitting newsletter to over 10K people and is constantly sharing his research gems on his Twitter account, which boasts 40,000 followers. Today, we dive into the psychology of how to remain optimistic despite having a portfolio that could be down 60%. We talk about Netflix and Twitter's current business model issues, and we get Alex to highlight some of his favorite recession-proof stocks that you should take a look at. The friend, marry, or kill question. I don't know. When was the last time you had one of those questions?
It's been a while. I roughly know the idea. I saw Ted Sarandos, the co-CEO at Netflix, did a big New York Times interview this weekend, and he was asked a version of this, and his answer was basically like, "Yeah, I'm not."
Yeah. Well, fortunately, we changed the F word at the start to a friend, not the one you're probably familiar with. Friend, marry, kill: Jeff Bezos, Mark Zuckerberg, or Elon Musk.
Friend Bezos, marry Zuck, and I'm not a big.
That's interesting.
guy. I've never looked too closely. So
Yeah.
He's done amazing things objectively, but some of the stuff's a little. He can get the cash.
Yeah.
That's good. Bit of foreshadowing for later when we dive into Twitter.
I was gonna say I'm not even a Twitter shareholder, but if I was, then I would definitely be on the K. I assume, because he's making their lives a little bit interesting.
Yeah, he is.
What was the first investment you ever made, if you can remember it, and what interested you about it?
First one I ever made. Gosh. This is probably wrong, but in the 07-08 period, I think that's the first time I ever really invested. There's two stocks that I can remember buying specifically. One was Evergreen Solar, which was at a time when solar is going to take over the world. No idea what you're doing as an investor. Just buy something that's in a space that's going to take over the world. I think they went bankrupt in pre-fair. I don't know. I don't think I still owned it, but they went bankrupt at one point. I'm fairly sure. Another one was, I think it was called Health Sports, HSPO or HYPO. I think they also went bankrupt. Their claim to fame was these. You remember the Listerine strips that you'd put on your
yeah.
for a while? It was that, but it cures a hangover.
Oh.
And being a young college kid, I saw the addressable market was very attractive. The problem is, I don't think they actually worked. And that's a pretty important selling point on your products. So I think they also went bankrupt. So yeah, two bangers right out of the gate.
You're killing yourself here, Alex.
Yeah.
Yeah. Well, I've learned a little bit in the last 15
Yeah,
years.
I'd say so.
To round out these fun ones, name one person you really admire in the investing world and why.
Oh gosh, there's so many. Does that have to be someone famous? Or
No, not at all. Just your personal favorite.
I mean, I'll do two. My good two people who have become really close friends through Twitter. My buddy Bill Brewster and my buddy Francisco Oliveira, and they're both they're different in some ways that they approach markets and investing, but they're both very deep thinkers, and I think they're just two people who get better every single day, which in my mind is the highest praise that you can kind of give someone. They're just constantly always working and trying to find the approach to investing that makes the most sense for them.
Yeah.
Awesome.
Could you describe the difference between the two of them, Alex?
Yeah, Francisco is very much we operate very similarly, which I just simply define as more concentrated, buying something with the clear intention of owning it for years. If you don't end up owning it for years, that means the investment was probably a mistake. And just really trying to find those great businesses that you can partner with through any period of time, which right now is a fantastic test on what that means in real life. It can be scary when you own something that's a little more fringe or has too much debt or whatever it may be. So that's kind of the route that he goes down more and more. And Bill has a little bit more, and he wouldn't take this as a knock, he has a little bit more of a trader in him. That feature or that characteristic of him, I think, has allowed him to build a little bit of a spidey sense for when things are turning in a way, and he's willing to get out of a business where he thinks things are turning. And I've seen him do it a couple times now, where if you're just I'm a long-term guy, I'm just going to ride it out. You can see how in a couple of these instances that would have been a mistake and a little bit lazy to do so, where something had materially changed. It was a reason to say, I know it just went down 10, 20% today. I'm still selling. And I think that's a really important tool to add to your toolkit, even for someone who is I'm only a long-term guy.
Alex, you were a buy-side equity analyst for 10 odd years. Can you give us the genesis story of the science of hitting? I think now you're working on that pretty much full time.
Yeah, the short and sweet of it is I went to college in 2007 at the University of Florida, Go Gators. And my dad's a plumber, so when I went to school, I was like, well, I don't really have any idea what I'm going to do with my life. I just go into building construction, and I pretty quickly realized that wasn't really the path for me. I specifically remember a physics class I took where I was like, well, maybe my dad knows how to do this stuff, but I don't know how to do this. I don't think I'm going to learn. So I stumbled across the Berkshire Hathaway letters at some point around then, and kind of just became hooked. Started reading about investing. Drove to the Berkshire meeting that year, which was a crazy drive with one of my buddies. Switched my major to finance. And then as I got closer to graduating, I was like, okay, well, I love this subject material and I want to do this with my life, but how do I actually go out and get a job? Everywhere I wrote to said some version of, let us know when you're 25 and when you have a CFA and an MBA and some job experience. And I needed to get a job to get some job experience. So I started writing around then. And as I finally got a job in the industry, I'd already come to the realization that writing was just so powerful for me in terms of kind of building a network of like-minded investors and putting my ideas out in a way that clearly expressed what I was thinking, as opposed to kind of diluting yourself sometimes into, hey, this is a really well thought out thing. And then when you got to put it on paper, you're like, oh, it's not really as deep as I thought it was. So I continued doing that over the past 10 years. And then as we come into, 2020, 2021, I was just seeing what people like Ben Thompson at Stratechery or David Kim, I just saw, hey, there's probably a viable path here outside of me just posting my articles on somebody else's website and getting paid a flat fee. Maybe I should explore some of this. So I spoke to people like David and just talked through the numbers, and I was like, hey, you know what? I'll give this at least a year and see how it goes. And if not, I can always, try to get back into the industry. So I launched in April 2021 and just passed a year last month, and it's been going very well. It's been a fun ride. I'm living through my first experience now of what a subscriber base looks like when the market implodes and the economy may be on some shaky legs. So that's a little bit less enjoyable, but that's life in basically any business, right? It's just cyclical to a certain extent.
Out of curiosity, with the subscriber base, have they held fairly strong over this kind of this period? I'm sure they're looking for advice in a weird kind of way. They're looking for guidance.
It's been an interesting period. I think before I answer real quick, there's a couple of things going on where, for one, this is, I kind of go through periods where I'm doing the quarterly earnings season reviews of the companies that I own or watch. And I think it's tough for that to be kind of something that drives that next subscriber. It's really more of, hey, people have been following it for a while, may be interested in, but like this morning, I posted another article about Dollar General, which is something I've owned for about a year now. It's not really going to drive that next subscriber because most people who have been following me would have already subscribed if they really cared about Dollar General. It's that deep dive on Roblox, or I'm trying to do Match Group right now. Those are the kind of things I think that get new people in the funnel. So these parts of the calendar tend to be a little bit drier, I think. But overall, I think from what I see in my numbers, the retention remains very, very strong. It's just been kind of the gross ad number. It's hard to get people to try something new, but we'll see if that changes in the coming weeks as earnings are kind of ending and deep dives are coming up.
You pride yourself on your transparency as well, don't you? So, I mean, that's obviously going to build that loyalty to your content.
Yeah. I mean, I again, as I was starting out, I looked at someone like David Kim and I was like, this guy does fantastic work. And there's plenty of other people like him that do fantastic work. And I just thought, is there something I can add on top of what I kind of do now to make this any better, for lack of a different word? And, coming out of the finance industry, one of my big complaints was a lot of this, this was stock XYZ was a great pick. And, the conversations are really centered around like, here's one individual stock that we like and that did well. And it's less framed around the context of what that means in terms of portfolio, in terms of position sizing, in terms of returns, et cetera. So I just thought, why don't I just completely knock all that down? I've made mistakes in public before because I've been writing online for long enough. I know it sucks, but I've felt that feeling before. Why don't I just take this completely to put transparency to 11? Anytime I do anything, I'll tell you, and I'll tell you why. And I'll, post returns on a quarterly basis. And it's been interesting. I think that I didn't really foresee this, but adding that layer to the service, I've been someone who's been fairly inactive anyways, but it stops even more of the tinkering that I might do without being forced to disclose to people that I'm even moving, call it 100 basis points from one position to another. Just do a lot less of those little tinkering things that I really wonder, like, how much value do they actually add at the end of the day? So I kind of just eliminated that from my decision making.
Yeah. So it's what, May 31st on your end, on our own list. A lot has happened since
We're in
Sydney, Australia.
Okay.
Down under.
Very nice.
Where are you?
I'm currently in Florida.
There you go. The Gators.
Oh, beautiful.
There you go. Figure. So the last 2 years, we've seen the markets have been incredibly turbulent. That huge dip over COVID, and then this massive resurgence. And now things are starting to get pretty shaky, at least in the growth stock sector. I saw over the last 5 days, there's been some resurgence. I think we're up 6% over the last 6 days. So maybe that's a sign of something. Can you give me your take on what's happening in the markets today and your short-term outlook, particularly in the growth stock arena?
Yeah, I think my biggest thought on what's happened, and you certainly see it at the company specific level, we've seen this wave of obviously complete fear and worry as we get started with COVID in early 2020, which obviously seems like a very appropriate response given what was going on at that time, followed by significant help from stimulus, certain businesses certainly thriving and doing quite well during that period, kind of your stay-at-home stocks, and then a big question about whether or not this is a pull forward or if it's, something more important or something more beneficial than that, kind of like a structural change in demand. And what we've seen in many cases is probably a pull forward that wasn't actually even sustainable. On the back end, some businesses look a bit worse than they probably did going in. I mean, like for Netflix, for example, kind of the trend line on their subscriber growth heading into COVID, we're now below the trend and that, it's obviously inclusive of some fantastic numbers on the front end. So they're below trend from where they were at. And I think it's kind of an instructive example because you see more and more of that across many industries, at least in my mind. So the article I put out this morning is about Dollar General, and Dollar General reported results and the market reacted very favorably with those results, but they basically just said, hey, the guidance that we gave you is still roughly right. And after Walmart and Target, who are, they're massive in the US, over $500 billion in US retail sales every year. After they came out and said, we're really seeing some parts of the business starting to take on water, especially kind of the general merchandise category. So, not food or, personal care products, kind of that more discretionary spend. I just think the market may be asking itself now, retail is an industry where if you look at a chart of the industry sales, they're still, call it 20% above what the trend line kind of was coming into COVID. So it's yet another example of where people are now asking themselves, or I think they should be asking themselves, is this actually going to hold? Or are we going to come back to trend here as well? Or maybe even go below trend? Mm-hmm. So I just think that's really what I see as I look across various industries, and obviously add on top of that, cost inflation, fuel inflation, et cetera. It's just, I think people pretty widely recognize, the consumer looks like they're in a pretty good position financially, but people are obviously becoming a bit more skittish, and it doesn't help when every time you go to the grocery store, it seems like the products are more and more expensive.
Mm. Yeah, absolutely.
Reading through your investment philosophy, I absolutely loved your metaphorical depiction of how you invest, specifically the quotes from Stan Druckenmiller and the anecdote from Charlie Munger. Can you expand on that a little bit, and particularly how you view portfolio construction in general, and also your investment process?
Yeah. So it's this is where I think investing is really interesting, because we all live in this world of kind of stock picking. And I think that's obviously an important component of being an investor, but there's also this other question of kind of asset allocation and just broader portfolio construction. So at a high level, I start from the perspective of asset allocation, and really the idea of being a structural allocation in my portfolio, meaning at any given time, I'm not changing my stock bond allocation. Given my age and kind of how I think about what my savings rate will be going forward, I'm pretty comfortable with, call it, a 95 to 100% equity allocation. So that makes life really easy in terms of basically never holding cash, and always just thinking about opportunity costs in terms of the watch list or the names that I currently own. The alternative would be a bit more tactical, which, say you could say, hey, I'm a 70-30 investor, but based on the market environment, I might go 50-50 or 90-10. I just think you get too much into market timing, and it's kind of a distraction in a lot of ways. And it's just very hard to do well over long periods of time. And I've seen that personally, and I've seen it with clients in my old role as a kind of investment advisor. In terms of, what was the other part of it all? Sorry.
Yeah, I mean, you've kind of ticked most of the general investment process.
In terms of, I could probably add in terms of like diversification and stuff, how I think about that. Because I run a concentrated portfolio with a small number of positions. I think I have 13 holdings currently. I just think about those as in the kind of the context that Charlie Munger has said before. If you own, a local McDonald's franchise, you own a gas station, you own, one or two other businesses, I think anybody would reasonably look at that and say, yeah, you're diversified in terms of your holdings as a business owner, especially if they weren't in the same, geographic region. And that's really how I think about it. I mean, Microsoft is a diversified business in its own right and has a very strong balance sheet. And, if I own Microsoft, Berkshire, Pepsi, and, one or two other stocks, from the perspective of a business owner, I think it's pretty clear that that's fairly well diversified. And, I just kind of approach it with that same thought process. That also obviously introduces some risk of pretty significant volatility and returns that deviate from the market pretty significantly. But if you're an active investor, that's kind of the cost of any shot about performance requires the risk of underperformance during periods of time.
You mentioned that you hold 95% odd of your wealth in equities. Can you explain from a psychological standpoint how you hold yourself together, knowing that most of your wealth is held in these equities that are probably down 40 to 60% on any given stock?
I think, one is just perspective. I'm in my early 30s, just turned 33 recently. I plan on being a net saver for another 10, 20 years probably. So I think I'm just constantly in the phase of, as Buffett likes to say, the idea of buying hamburger meat cheaper than you were yesterday. Nobody complains when they're doing that. And that's kind of how I view the opportunity to buy, additional shares of the companies I'm invested in. So that's really how I think about it at a high level. And then again, I know the prices move around very, very significantly, but, I have a minority ownership position in these businesses. And in many cases, something like Dollar General is an interesting one because the business is really counter-cyclical of anything. So if the market goes, their same store sales in 08 and 09 were up basically 10% each year, which is, very, very strong numbers. So to the extent a stock like that goes down significantly during a period of market angst or even macroeconomic headwinds, to me, it's just completely irrelevant because the business is as strong or more likely stronger than it was, heading into that period. So I think it's just having that perspective. And then for each individual, it's making that decision in a way that's relevant for you. If you're, if you have a lower risk tolerance and or your financial situation is different, you're 60 and you plan on pooling funds in the next 5, 10, 20 years, your allocation should be adjusted to what's appropriate for yourself.
Have you always adopted that mentality, or was this a long journey of learning from mistakes and transitioning into, I guess, the ethos that you embody now?
It's a good question. I think I certainly had periods in the past where I held more cash. I think I've always had the perspective that when you get past 10, 15, 20% cash, you're getting into this dangerous territory where you can really become someone who's market timing, for lack of a better term. And it's something I've always kind of wanted to avoid. I've become stricter in just saying, cut the cash almost to zero. Because one, I think it's the right decision over the long term in terms of where my dollars will be. But two, I also think it changes the way that you think about the decisions you make in your portfolio and how you think about opportunity cost. A good example is right now when stocks are going down a lot. You have cash sitting on the sideline. It's fairly easy to say, I've been waiting to buy XYZ at a 20% discount to where it was at. Now I have that 20% discount to where it was at. I'm going to buy it. That decision is a lot harder when you look across your portfolio and go, well, to fund that, I have to sell something that's down 25%. And I like these positions as well. I think the bar is raised a little bit in terms of that decision, but I think it also probably leads to more thoughtful decision making, because you may need to look at something and go, I know this is down, but I need to sell this to buy what I think is objectively a better business. So I think it just raises the bar in terms of your decision making. But yeah, a lot of this has been an ongoing evolution, and I think that's an important part of being an investor as well. You mentioned a second ago, Stan Druckenmiller, who I'm not intimately familiar with his investment process, but my sense is it's quite a bit different than my own. And I think one thing to avoid as an investor, and something I try to do better at every single day, is picking up learnings from people who don't see the world exactly as you do or play the game differently than you do. And I think there can be a lot of value in that, even if it never directly translates into how you make your own decisions.
Sure. Might just loop back, actually, going off that point. Was it that the two gentlemen you mentioned, Bill was the one that has quite different investment strategies to you?
At times, yeah.
Okay.
Yeah, at times. And he's, again, as I said there, and I think he's become very attuned to when something changes in a way that materially changes the thesis. And that's something that, in my experience personally, and watching people who kind of operate like myself, that's something that's really hard for long-term investors to kind of do, because you always have this idea that something goes down 20 and you're like, okay, but my estimate of value went down 10. So it's actually more attractive than it was. And that's where value traps really lie, at least from my experience.
Alex, before we jump into the stock breakdown portion of things, I just wanted to get your view on get your outlook on growth stocks over the next 18 months. We spoke about mindset, and I'm curious how you're going to position yourself with this in mind.
Yeah, well, the short answer is a very helpful one, which is I don't know. The longer answer is, as I look at some of the names that I'm invested in that kind of fit into that bucket, I would just simply note that the sentiment on a lot of them has clearly become quite negative. And, even the conversations I have with people, it's funny how quickly we've gone from what's the TAM, what's the most optimistic scenario, what are margins going to be like at run rate, to, do they generate any cash today? Can they pay their bills? Fair questions to ask, but everything's jumped to the side of really what's the risk here, and less so kind of what's the opportunity and upside. I think Netflix is a pretty good example of that, because they clearly have a number of levers that they can potentially pull in order to kind of change their business, both in terms of the customer perception of the product, but also the financials in certain situations. Now, AVOD is an interesting one. Yeah, it's supported tier. Theatrical releases, another interesting one. And then some other things that are a little bit behind the scenes, like staggering the release of shows, et cetera, et cetera. These are all open to them. And some of these ideas are probably something that they should implement, and they could have a material impact on the business. But those conversations are less in front of people at a time when they're more worried with, is the stock going to go down another 10% or 20% from here? So we'll see what happens over the ensuing year or two. But I feel like sentiment has become quite a bit negative. And generally speaking, that's a good time to own a stock, especially if the business is performing.
Right. Well, we should chat about Netflix here and jump straight into it, as you mentioned it. Just a little backdrop for you. For the full year of 2022, the company reported that their customer base reached 220 million paid subscribers around the world, an increase of 180% over the last 5 years. We also know that year over year, Netflix subscriber growth has declined. It seems like it seems like everyone owns a streaming service in some capacity these days. Can you set the scene for Netflix before we jump into it and describe just generally what has happened and why things have turned so aggressively for them?
Sure, and I'll try to keep this short. They launched their streaming service in '07. They've basically been running with everybody else for the past 15 years. There's always been talk about competition, which has existed in various forms over that period. Most notably, early on would be Hulu and Amazon Prime Video. Disney Plus launched in late 2019. Over the ensuing 2.5 years, it's quickly built a 130 million global paid sub base. So just very significant growth, obviously relative to that 220. It's a different ARPU than Netflix, quite a bit lower, but still the ability to get that sub base. I think most people look at that and say, kind of building up the sub base is where you start, and you hopefully have the ability to take ARPU over time, which in the case of Disney, I think they pretty well can. So you had competitive dynamics that were becoming quite a bit clearer than they had been. And obviously when you start at something close to, this is hyperbolic, but you start at something close to 100% market share and competitors come into market, you're going to have less than 100% market share afterwards. So they've gone through that period. And, as I said earlier, coming into COVID, they were at a run rate of, call it 25 million net adds per year. In COVID, in the first 6 months of 2020, they added 25 million subs in 6 months. So just massive growth. As we come to the back end, we had this question of what's it going to look like. I think the market somewhat thought that this is going to be contained to a, relatively finite period of time. As we got here to 2022, the expectations were changed very significantly, and management has basically said up till now, we just kind of misassessed what that meant, and we are going to have problems growing the sub base, some of which is, specific to the company, and other reasons that they gave at least are a bit more external, and they'll have an impact on everybody. I think in terms of what this means for Netflix and how they kind of approach it going forward, they're in a position where they have a recurring revenue base on the current subscriber count of more than $30 billion a year. They have a content budget that's grown very significantly over the past 5 to 10 years. I really think they've navigated through that first period from the perspective of spend every dollar we can, basically, or close to it, and grow as much as we can, because this is a land grab, and we need to try to cement our position in the early days of this new industry that will presumably be around for decades. Now we've reached a different point of that kind of growth curve, and I think they will use this as an opportunity to reassess, one, the level of spend, two, what they're spending on. I mean, it's very clear that in terms of something like IP, they just come from a very different position than competitors who have decades of building or buying franchises. I mean, Disney is a very clear example of a number of franchises that Netflix has nothing close to. On the other hand, that $30 billion revenue base and 220 million global subscriber base also presents a lot of advantages. I'd like to talk about Drive to Survive, the Formula One series, which, reinvigorated the sport in the US and has had a big pull in other parts of the world as well. I just think if you talk to the Liberty guys who own Formula One, it's pretty clear that Netflix was by far the best place for them to distribute that content on, and the price tag that Netflix has to pay on that as a result should presumably reflect some of that value. So I think there's a number of ideas like that they'll start to explore more deeply now that priorities have changed somewhat.
Yeah, it's interesting you mentioned Disney. I definitely underestimated the goodwill that Disney had with consumers, and their growth has been exponential since 2019, like you said. And it's funny because I was watching Succession last night. I think it was like the last episode of Succession that's out, and they're trying to buy the streaming service, and the main character's sort of business was this old legacy media business, and they have all the content, and the streaming service is the newcomer, and it kind of feels like that, where Disney had the upper hand because they had all these great flicks. Star Wars, for example, Obi-Wan Kenobi just came out. Do you see the Netflix original content model not scaling over the next little while, just because it seems like they're injecting so much capital into this original content model, and without growing subscribers, it makes it hard for them to justify that as a cost? Do you see it that way as well?
Yeah, I think there's definitely a link between the two, and it's kind of funny. A big knock on Netflix has been the kind of the accounting discrepancy between cash flows and the GAAP income statements, given how the content spend's amortized. And I used to joke a little bit before we came through this period that if you're a Netflix pool, the thing you don't want to happen is for those two numbers to come together, because you want the content spend to keep growing, because that suggests that the subscriber base and the revenue base is continuing to grow. It's pretty clear that we're going to see the opposite of that now. Those two numbers are going to start to converge, at least as things look today. I think it's, again, as I mentioned a moment ago, I just think it's a big problem for them to address is when they put, call it $200 million behind a movie. It's a lot different than making the next version of the Avengers, where you have a fan base, you have a really good sense that if you produce a halfway decent movie, you're going to get hundreds of millions of dollars or $1 billion plus in box office revenues, and then it has the ability to really drive your streaming service on the back end. Netflix is, with evergreen IP or evergreen content, you don't have that same assurance. So that really requires you to up your game and to find a lot of things like Squid Game and the like. And, we're finding out that that's pretty hard to do. I do think there's potentially some of the issue here with what's the term for, when you go to a grocery store and there's 20 different brands of grape jelly, it's harder to make a choice because there's so many options, as opposed to walking into a Costco and you got Kirkland and you have Welch's, and that's it. And it just makes it much easier. I think they probably have an ability to cut back their spend in a way that actually adds to the user experience potentially. So there's a lot of options.
It's kind of like perfect competition. When I walk around my area, there's like 30 Korean barbecue places, and they perfectly compete against each other, and they drive away all those extra dollars that they can make. And it just seems like that in this industry. Now we're going to jump over to Twitter as well, and you kind of alluded to this at the start of the conversation with your scathing remarks of Elon Musk. I'm not sure he'll mind that you want to kill him in quotations, but what's your take on this whole charade? Like, Elon comes in, he wants to, well, firstly, Jack leaves, Parag comes in, Parag gets slammed, Elon comes in, Parag gets basically kicked out, and then Elon says, it's 80% bots. Like, is this him trying to is this him trying to garner attention? Is this a genuine bid? Like, what's your take on all of this?
Well, first, to clarify, if he's watching this, I do not want to kill you. I just want to be very clear about that.
We'll edit this out, Nathan.
I think I think how this all came together, and I don't want to. So I first wrote about the company about a year ago, and kind of the underlying idea that I talked about was, the company had an investor day and then set some financial targets that, in my mind, looked pretty aggressive almost immediately after they were laid out. And like a lot of businesses, they may have just misassessed what COVID meant to their business. But you reached a period where even the bulls, the people I talked to who own the stock and really like the company, even they were like, yeah, in terms of this monetizable DAU, daily active user number, MDAUs, it's just a stretch to see how they get there. And, I think the company partly put out these aggressive numbers because they were facing activist pressure, and it was kind of the way to save Jack's job at the time. I think, at least that's my read on what happened. So they're kind of backed into a corner and then put these numbers on the scoreboard. You get to late 21 and Jack leaves and Parag takes his position. And I think in hindsight, I think that was the time for them to maybe step up and say, listen, this is, to the extent they believe this, this is not really feasible. We're going to take those numbers off the board, maybe have numbers that are a bit more long-term as opposed to 2-year targets. And we're going to give Parag a fresh slate. They didn't do that. And I think it really became a problem when Elon shows up and starts making noise and then makes a real bid. Now you have to sit down in the room and try to present numbers to people or give some reason to say that this deal is something we shouldn't do given the financials of the situation. I just think that's really, really tough if you're sitting there and you go, we're gonna come to market in 3 months or 6 months and tell people that we can't hit the targets that we gave them. So I think in some ways they got backed into a corner on that one, and it was partly a self-inflicted wound, but in their defense somewhat, they kind of felt that they had to do it at the time in order for Jack to stick around. So Elon made the bid. Obviously, there was a lot of talk of someone's going to come over the top, and there's plenty of people who want this asset. It's so valuable. And then we saw that, it's really not the case. Effectively, I mean, nobody really, there was a lot of chatter, but nobody showed up to make a competing bid. And, now we're talking about it in the other direction, where is Elon going to try to negotiate lower? And it sounds, I haven't followed the nitty gritty of this incredibly closely. I've been reading a lot of Matt Levine over at Bloomberg, who's just done a fantastic job on all this. It sounds like, despite the noise that Elon has made, it sounds like behind the scenes that the financing's firming up a little bit, and the deal may potentially be getting closer to where it needs to be. So it's pretty fascinating that the spread is still incredibly wide. But it's a tough situation for Twitter. Another notable thing, when Parag came in and there was a bit of a reorg, there were 3 people who effectively, I don't know if they were necessarily promotions, but they were prominently called out in terms of the reorg. And, 2 of the 3 people have since left. So I'm sure internally it's a situation where, and not to mention the stock price is, lower today than it was at the time after the first trade of the IPO and back in 2013. So it's a very tough situation. And culturally, I imagine it's even more so, especially when you're competing with, Facebook, Google, et cetera, for talent. The ability to pay and the ability to have a stock that is really meaningful as part of that comp, that makes life very difficult when you're trying to compete for that top 1% of talent or top 10% of talent.
Yeah, 100%.
Yeah. They've tried as well with multiple different releases, Spaces, Super Follow, Twitter Blue, all trying to drive daily actives and I guess optimize monetization. But yeah, things look grim. Do you think there's any way they can correct their course?
Yeah, I think it's funny, and I speak about this a lot my perception on a lot of this is really from a user, because I use the product all the time. Spaces seems like they really cracked something, and maybe that's still true today. As a writer and someone who accounts, my user growth for my subscription service, the vast majority, at least historically, has been from organic Twitter, from building an audience on the platform. Twitter bought something called Review, which is essentially a competing newsletter service to Substack. And when they bought it, it was a really small team and, basically a relatively new product in terms of functionality and the like. But it's integrated directly into your kind of Twitter user base, and you can see how that could potentially be really compelling. And I kind of wrote in the first article that I put out about the company that I think it's a good example of where a lot of their problems lie. The service has some pretty glaring, and I'm as far as I know, they still haven't addressed some of these things, but it has some pretty glaring feature gaps. For example, for one, when you read an article at the time, when you get to the bottom and they have a thumbs up or thumbs down for the article, it wasn't even a button. It was just a picture. You couldn't click it.
Jeez.
So it wasn't a real thing, basically. Another glaring example, they wrote a blog review. The team at Review wrote a blog 2 or 3 years prior that said, here's how you can kind of build and sustain a subscriber base. One of the things they discussed was annual subscriptions, which is something that's very important as a product feature for a writer like myself. To this day, as far as I know, Review still doesn't have annual subscriptions. They only have monthly. So, it's simple things that if they spoke to 3 writers who do this for a living and asked, what gaps do we need to fill? It's stuff you should be able to fix very, very easily. Their inability to do so, in my mind, speaks to a lot of the problem. And I've just always questioned whether the approach should be to go out and buy something like that versus finding ways to really intelligently partner with someone like Substack to say, listen, this isn't our core competency. We are kind of the social network for someone like you, and you have to have us in order to grow your business, and we'll participate in it that way. But yeah, I mean, at the end of the day, the business is overwhelmingly advertising revenues, and no matter what you say about subscriptions, tipping, super follows, et cetera, they just really haven't shown any ability to get the user base to be willing to pay for those things. So they're a difficult spot. And again, just to add to the prior answer, now you're dealing with cultural issues as well, and employees. And there was a lot of talk about, hey, if Elon actually buys this company, internally it's going to be a big issue. And you're starting to see big names at the company leave, and that's rarely a good thing. Parag wrote pretty prescient in hindsight, that basically there's going to be a lot of noise. We're just going to keep our heads down and continue to do the work that we need to do. And that was a letter he wrote to employees when the deal was either first announced or when it actually closed. And, I think we've seen over the last 6 weeks or so that has proven very, very difficult to do.
Yeah.
And it's not good for Twitter.
Might move on into the next phase of the podcast. We wanted to open up the floor a bit and discuss a potential exciting opportunity that's captured your attention. It could be an undervalued stock, it could be a swing trade, or even a macro play. Just for the listeners to hear where your eyes are and where your head's at.
That's an interesting one. What do you think? Well, I like a lot of the names in my portfolio right now. The fact that most of them have gone down a lot more than they've gone up certainly helps that. Prices look a bit better. Let me pick a name I don't own. I think Five Below, which is I've written about the company previously. I need to do an update. It's a retailer in the U.S. that basically their value proposition is most of the products are priced at $5. It's kind of tchotchkes and things that are sold to preteens, teenagers. It's something like you go there, and if you had $20, it's a place you can go and find 4 kind of silly things to buy that you'd like to have, but that you wouldn't really see sold anywhere else necessarily. I think the title of the article I wrote at the time, I might forget it now, but it was something like we sell stuff that nobody needs, basically.
Right.
So it's a unique concept that's found a bit of a niche and has worked very well. And they have a huge unit growth opportunity to the extent the economics look similar to the base today. There's very attractive returns on that incremental capital that's invested in the business. I think they did an investor day fairly recently and put out a guide of getting to, call it $10 of earnings in the next handful of years. And last I looked, the stock price probably moved like crazy because retail's been all over the place. At least U.S. retailers have been all over the place. But I think it was getting down to, call it a low double-digit multiple of that kind of earnings projection. So that's one that's worth looking at, and I'll be updating shortly. Another really interesting one in retail is, I think, Ollies, which is Ollies is effectively a closeout retailer. So, let's say a sporting goods store goes out of business, or, Procter & Gamble decides to change the packaging on a certain size of Tide. Ollies is a banner that buys those products at a huge discount to what you'd pay at retail, and then sells them to customers for, call it 50% less than what a comparable product would cost at a normal store. What's interesting about Ollies right now, in my mind, is, as Target and Walmart both kind of indicated 2 weeks ago now, I think, they've seen a real mix shift in their business from the huge kind of general merchandise discretionary growth that they saw throughout the pandemic. Now they're seeing a mix shift back towards consumables and the like. So the products that are, my understanding is the products that are in the stores, obviously most of those will just be sold through the channel in terms of discounts at those retailers or markdowns at those retailers. The stuff that's still in the supply chain, I think in theory, some of that could end up at Ollies. So their merchandise and their inventory they should have a lot of opportunities right now to attractively buy merchandise. The big question in my mind is their customer base is someone who I kind of view it as, okay, I got done with my shopping needs for the week. I have $25 left. I had $50 left. I'm going to go to Ollies and buy, some products to buy. That consumer is certainly struggling right now, as everybody is to some extent, from high fuel prices and high food prices. But I think they might be getting hit more than most. So that shopping trip might just completely drop away. So I think it's something to watch closely and to see how their results kind of roll out over the next coming years. But it's a story that's been really messy, and I think the underlying economics of the business, at least historically, have been fairly attractive.
Alex, mate, it was an absolute pleasure to have you on. And we'd love to have you on again at some point. So this platform is your platform. If you have any ideas or any opinions on stocks that people should be looking at or some analysis, you're always welcome to reach out to us and use this as a way to spill your guts, so to speak. Is there anywhere you would like to send your guests before we wrap up the show?
So the best place is probably, I assume most people are probably on Twitter, at TSOH_investing. And then, I run the TSOH Investment Research Service, quick pitches, spent 10 years as a buy-side equity analyst, been writing online for a very long time. With the service, I send a deliverable every Monday and every other Thursday. Get